So imagine two investors. Let's say they both worked hard, saved diligently, and they each start their retirement with exactly $500,000.
Okay, sounds like a good start.
Right. And they have the exact same lifestyle, meaning they both need to withdraw $30,000 a year from that nest egg just to, cover their living expenses.
Right.
And over the next 20 years, they both average a 7% return on their investments.
So same starting amount, same withdrawal rate.
Exactly. Same time horizon and the exact same average return. So based on all of that, do they end up with the same amount of money after 2 decades?
Well, the intuitive answer, right, the one the human brain immediately jumps to is yes. Because if all the variables average out to the exact same numbers, the destination just has to be the same.
But the reality is a staggering $550,000 difference.
Oh, yeah, it's wild.
Like one investor sitting comfortably, the other is dangerously close to running out of money, just staring at the ceiling at 2 in the morning, wondering where it all went wrong.
Yeah, and that massive gap, it actually has absolutely nothing to do with how much they saved or their average return over that time period.
Right.
It comes down to a single hidden variable that standard financial planning tools routinely just gloss over.
Welcome back to this deep dive on the safe descent. I'm Marcus Reed.
And I'm Dana Spencer.
So we are doing something a little different today.
Mm-hmm.
We're exploring a special companion discussion to Season 1, Episode 3 of Tod Long's The Income Standard.
Which is such a great resource.
It really is. And the framework we're exploring is part of a concept called the safe descent. So our mission today is to unpack what is arguably the most underestimated threat to your retirement income.
Yeah.
We're looking at a specific financial phenomena that is, frankly, practically invisible in standard average return planning tools.
Yeah, and I think what really stands out in Tod Long's work is how this hidden threat operates entirely in the shadows of conventional financial advice. He calls it the sequence nobody warned you about.
The sequence.
Yeah. So the goal today is to kind of bring it out into the light, break down the actual mechanics of why it destroys otherwise solid retirement plans, and then look at the structural solutions required to actually fix it.
So let's pull apart this opening riddle right out of the gate. Cause a $550,000 difference between two identical average returns honestly sound like broken math.
It does. It really does.
How do we even arrive at those numbers?
Right. So it all comes down to the order of events. Let's look at investor A.
Okay.
This person retires, and they just happen to get lucky. The market is booming.
Good timing.
Exactly. They get strong, positive returns in the early years of their retirement, and then they experience weaker returns or, even some significant losses, but much later on, say 15 or 20 years down the line.
Oh, I see.
Because of that strong early growth, even while they were skimming off that $30,000 a year for living expenses, their portfolio just continues to compound.
Right. It outpaces what they're taking out.
Exactly. The underlying engine outpaces the withdrawals. So at the end of 20 years, investor A has approximately $800,000 remaining.
I want to pause on that math because that is incredible. Yeah. They started with $500,000.
Right.
They took out $600,000 over 20 years to live on.
Yep.
And they still have $800,000 left in the bank. I mean, that is the dream scenario.
It really is the absolute ideal. But now we look at investor B.
Okay.
This person retires. And they walk out the door on day one, and the market immediately tanks.
Oh, man.
Right. So they take steep losses in those critical early years, and it's followed by a very strong recovery, and boom, years much later on.
So the reverse of investor A.
Exactly. The overall average return across the 20 years is still mathematically 7%.
Right.
But because investor B took those losses right at the beginning, while they were simultaneously pulling out $30,000 a year to buy groceries and, pay property taxes.
Right, because the bills don't stop.
Exactly. The portfolio is decimated. The compounding engine is basically broken. So at year 20, investor B has only about $250,000 remaining.
Wow. So we have $800,000 versus $250,000.
Yeah.
That's the $550,000 difference. And literally the only thing that changed was the sequence.
The literal order in which the returns arrive, yes. Mm-hmm. And in the financial world, this is defined as sequence of returns risk.
We really need to push back on this whole concept of averages.
Oh, totally.
Because we are so conditioned to look at the average return of a mutual fund or, the average historical return of the S&P 500, and we just project that forward on a spreadsheet like it's a smooth upward sloping line.
Right, like it's guaranteed.
Yeah. But an average is incredibly deceptive. I look at it a bit like taking a road trip.
Okay.
If someone tells me we're going to average 60 miles per hour on a journey across the state, I mean, that sounds like great, steady progress.
Right. Nice and smooth.
But what if we spend the first hour of the trip stuck in a ditch at 0 miles per hour?
My God.
Just, revving the engine, spinning the tires, and burning through half our fuel.
Yeah.
And then, once we finally get pulled out, we drive 120 miles per hour for the second hour.
I mean, mathematically.
The mathematical average of those 2 hours is still 60 miles per hour.
Exactly.
But the experience of the trip, and frankly, more importantly, the state of our gas tank, is wildly different.
That is so, so true.
The average doesn't matter if you run out of gas before you even hit the highway.
Yeah, that road trip analogy perfectly captures why standard planning tools kind of lie to pre-retirees.
Right.
Because when people sit down to plan for retirement, the industry standard is to use what are called Monte Carlo simulations.
Okay.
And these are statistical models that run thousands of randomized hypothetical market scenarios just to see if your money will last. So a planner might run your numbers, look at the results, and tell you that you have, say, a 92% chance of success.
I mean, I hear that, and my immediate reaction is relief. A 92% feels like getting an A- on a test. I'll take those odds all day.
Right, it sounds incredibly comforting. But fine is just a probability score. What the simulation fundamentally glosses over is what actually happens in that 8% failure rate.
Oh, right.
Those aren't just random scenarios where you end up with, slightly less money for a vacation. Those are specifically the scenarios where a bad sequence hits right at the beginning of your retirement.
The ditch.
The ditch, exactly. If you are in that 8%, your failure isn't a mild inconvenience. It means running out of money when you are 82 years old with declining health and absolutely no ability to go back to work.
Wow. That shifts the perspective entirely. So let's get into the weeds of the mechanics here.
Sure.
Why does the timing of a market drop cause so much more destruction than the size of the drop itself? I mean, a 30% drop is a 30% drop, whether I'm 65 or 85. Why does it matter when it happens?
So it is dangerous synergy of withdrawing money while an asset is simultaneously declining in value. Like when you are working and saving, a market drop is actually a fantastic opportunity.
Oh, because things are on sale.
Exactly. It's dollar cost averaging in your favor. You are buying shares at a discount. But in retirement, when you flip the switch from accumulation to distribution, that entire mathematical reality completely inverts.
Because you aren't buying anymore. You're selling.
Exactly.
Yeah.
Let's think about that flat $30,000 you need for living expenses.
Right.
In a booming market, maybe you only have to sell, 300 shares of your mutual fund to generate that cash.
Okay.
But when the market drops significantly, the price of your assets falls. So to get that exact same $30,000 to keep the lights on, you are suddenly forced to sell 500 shares or 600 shares.
Oh, wow. So you're liquidating a dramatically larger percentage of your overall machinery just to maintain the same baseline.
Yes. And this causes irreversible impact because when the market inevitably recovers, which it historically always does,
Right.
Those liquidated shares are gone forever.
They can't bounce back because you already sold them.
Exactly. They can't participate in the upswing. You've permanently impaired the portfolio's ability to heal itself. Basically, you sold the machinery that was supposed to generate your future growth.
We've touched on this metaphor before in our previous discussions, and it feels more relevant here than ever, the mountain descent.
Oh, yeah. Perfect analogy.
Right. Because when you are climbing a mountain, your singular goal is the summit. That's your working years, saving, grinding, growing the portfolio.
Yep.
But mountaineers know the real danger isn't reaching the top. The fatalities mostly happen on the way back down.
Yay.
That descent is retirement. And the sequence of returns risk is basically a whiteout blizzard on the mountain.
That's a great way to put it.
It isn't about whether a storm hits the mountain. I mean, markets always crash eventually. It's about where you are standing when it hits.
Exactly.
If a massive blizzard hits when you are at base camp, safely at the bottom, which is like a 30% market drop in year 18 of a 30-year retirement, right, you might be annoyed, but you're safe. The damage is minimal.
Yeah.
But if that identical blizzard hits in year 1 or 2,
Yeah.
right when you are stepping off the summit onto the sheer icy descent,
Yeah.
the consequences are catastrophic.
That visualization hits the nail on the head. And honestly, we don't even have to rely on metaphors or theoretical math here. We can ground this in recent history.
Oh, definitely.
Tod Long highlights 2 massive sequence of returns events in the last 25 years alone. You've got the dot-com collapse from 2000 to 2002 and the financial crisis of 2008 and 2009.
Yeah, I mean, think about retiring in January of 2000.
Right.
You were feeling great. The market has been roaring through the late 90s, and then you just walk straight into a buzzsaw for 3 consecutive years.
Exactly. Both of those historical events landed exactly in the early retirement years for a specific cohort of people. You know, those who retired in the late 90s or the mid-2000s.
Right.
And for many of them, it caused permanent, life-altering financial damage. But here is the crucial takeaway that people misunderstand.
Right.
The damage wasn't because the market failed to recover.
Because it did recover.
It did. The market recovered from both of those crashes and then went on to hit all-time highs.
Right.
The damage happened purely because of the forced withdrawals during the downturn. Retirees had to sell so many shares at rock-bottom prices just to pay the mortgage and keep the heat on. So when the recovery finally came, they simply didn't have enough shares left to ride the elevator back up.
Which is legitimately terrifying because nobody can predict the market. I don't care how smart your advisor is, you cannot control what the global economy decides to do the month after your retirement party.
You really can't.
So if we can't predict it and we can't time it, how on earth do you survive that storm?
Well, you have to change the structure.
Okay.
This raises a fundamental question about how we view retirement income. According to Tod Longer's framework, the industry has kind of programmed us to rely on a withdrawal strategy.
Right.
Which is really just crossing your fingers, pulling money out of a volatile pot, and hoping the market cooperates. We have to move away from that and transition toward building an income architecture.
An income architecture.
Yeah.
We need to break down what that actually means in the real world because it sounds great, but I want to know the mechanics.
Sure. So a withdrawal strategy depends on probability. An income architecture relies on contractual guarantees.
Okay, big difference.
Huge difference. The structural fix that the income standard proposes is the bucketing or shield strategy.
Right.
The core concept is that you separate the sequence-exposed money, so the funds you need in the short term.
From the growth money.
Exactly.
I see. So instead of treating your entire life savings as one giant checking account that constantly is exposed to the stock market, you are partitioning it.
You take a calculated portion of your assets, an amount specifically sized to cover your non-negotiable living expenses during those vulnerable early years of retirement, and you move it into a fixed, guaranteed growth vehicle. In Todder's framework, this often involves tools like a fixed annuity or a multi-year guaranteed annuity, known as an MYGA.
Okay, I have to stop you there. You just said the word annuity.
I did.
And I'll be honest, the minute I hear that word, my walls go up.
Oh, I get it. Most people do.
Right. I mean, I've read the articles. I've heard the financial gurus on the radio yelling about how annuities are riddled with high fees. They cap your upside and they lock your money in a vault where you can't touch it for a decade.
Yeah.
Are we really saying that an annuity is the silver bullet here?
That is the absolute most common and entirely justified reaction. The word annuity carries a ton of baggage because there are hundreds of different types, and many of them are terrible, expensive, and opaque.
Right. Bad ones given all a bad name.
Exactly. But we aren't talking about variable annuities that are stuffed with hidden fees and market risk. We are talking about highly specific, fixed contractual vehicles. Let's look at a multi-year guaranteed annuity, or MYGA, for example. Conceptually, it functions very much like a CD you would get at a bank, except it issued by an insurance company.
Yeah.
You give them a lump sum, and they guarantee you a specific interest rate, say 5% or 6%, for a specific number of years. There are generally zero fees attached to a MYGA because the insurance company makes their margin on the back-end investments, not by charging your account.
But what about the liquidity issue? If I put my money in there, it's locked up, right?
Yes, there is a trade-off, and you have to be clear-eyed about it. You are trading absolute liquidity for absolute certainty.
Okay.
You typically have access to 10% of the account value penalty-free each year, but if you want all your money back in year 2, yeah, you'll pay a surrender charge. But remember the context of the strategy here.
Right.
We are only putting a specific portion of your assets into this vehicle to act as a shield. We aren't locking up your entire net worth.
Right. That makes sense. So let's talk about the other one you mentioned, the fixed index annuity, or FIA, especially with an income rider. How does that actually work mechanically? Like, how do they guarantee I won't lose money if the market drops 30%?
It's a pretty brilliant piece of financial engineering, honestly. With a fixed index annuity, your money is not actually invested in the stock market.
Wait, it's not?
No. The insurance company holds your principal in their general account, which is mostly heavily regulated corporate bonds.
Okay.
To give you some growth, they use the interest earned on your money to buy options contracts on a market index, like the S&P 500.
I see.
So if the index goes up, the options pay off, and your account gets credited with a portion of that gain, which is usually capped at a certain percentage.
Right.
But if the index goes down, the options simply expire worthless. The insurance company doesn't credit you any interest that year, but your principal remains 100% intact.
Wow.
Your floor is zero. You mathematically cannot lose money due to a market decline.
So that's the trade-off again. I give up the chance to make 25% in a massive bull market because my gains might be capped at, say, 8% or 10%.
Right.
But in exchange, when the market drops 30%, I lose absolutely nothing.
Precisely. And when you attach an income rider to that FIA, you are basically buying a contractual guarantee from the insurance company that they will pay you a specific monthly income for the rest of your life.
Regardless of what the market does.
Regardless of what the underlying account value does, and regardless of how long you live.
That's powerful. Let's put some hard numbers to this.
Yeah.
Because I really want to see this bucket strategy in action.
Sure. Let's walk through one of the specific case studies from the income standard.
Okay.
We have an investor with a $1.2 million portfolio. They sit down and calculate their basic non-negotiable living expenses. So, housing, food, healthcare, utilities.
The essentials.
The essentials. And they determine they need $54,000 a year from their portfolio to survive. Now, let's hit them with a severe sequence of returns event. Let's say a 34% market drop in year 2 of their retirement.
Year 2. Right as they are stepping onto the sheer ice of the descent.
Yep.
Let's look at scenario A first, which is the no-floor scenario. This is the standard withdrawal strategy that most people have.
Right. In scenario A, they desperately need that $54,000. So when the market drops 34%, their portfolio value has plummeted, but their bills haven't changed.
Right. The mortgage company doesn't care about the S&P 500.
Exactly. So they are forced to sell off a massive chunk of their remaining assets at the absolute bottom of the market just to get the cash. And this action permanently locks in those market losses.
Right.
The overall market eventually recovers over the next few years, but because of those early heavy force withdrawals, their personal portfolio is permanently impaired. The math never heals.
Wow.
By the time this investor reaches age 85, they have $340,000 less than they would have had if the market drop had happened later in life.
That is a staggering penalty just for retiring in the wrong year.
It is.
Now let's run the exact same numbers, but with scenario C, what the source material calls a closed floor, or a true income architecture.
Okay, so in scenario C, we have the exact same starting balance, $1.2 million.
Right.
But this investor has structured their income in advance. They combine their Social Security benefits with a fixed index annuity that has an income rider. Together, those guaranteed contractual sources completely cover that non-negotiable $54,000 a year.
So the floor is closed. The basic survival money is entirely insulated from Wall Street.
The floor is completely closed. Now, the exact same sequence event happens. The market drops 34% in year 2. But here is the magic of the architecture.
Okay.
Because the $54,000 is arriving every month like clockwork from the guaranteed sources, the investor sells nothing from their actual investment portfolio.
Oh. Their growth bucket just sits there.
It just sits there. The portfolio takes a hit on paper, sure, but because they aren't forced to liquidate a single share to survive, the portfolio is fully intact. When the market inevitably turns around, it rides the entire recovery back up. At age 85, this investor has $340,000 more than the investor in scenario A.
That's amazing.
Plus, they have that guaranteed income floor that never stops paying no matter how long they live.
I really want to lean into the psychology of scenario C for a second, because I think the mental health aspect of this is just as important as the spreadsheets.
Oh, absolutely.
Imagine the sheer peace of mind of waking up, turning on the morning news, and seeing a massive red 34% market drop flashing across the ticker.
It's usually terrifying.
Right. For a normal retiree in scenario A, that triggers pure primal panic. It triggers the reflex to call their broker, sell everything at a loss, go to cash, and hide under the mattress.
Which is mathematically the worst possible thing you can do.
Exactly.
Yeah.
But if you have a closed floor, if you have that income architecture, you can watch that exact same news broadcast and know with absolute certainty that your monthly income hasn't flinched by a single penny.
Yeah.
You don't have to panic. You can just let the market do what the market does, knowing your descent is safe.
That psychological relief is immense. I mean, it allows you to actually enjoy the retirement you worked so hard for, rather than spending it anxiously checking stock tickers.
Right.
But there is another crucial aspect of sequence of returns risk that we really need to clarify, because this isn't a boogeyman that chases you forever.
Okay.
It is not a constant, lifelong threat.
It's a very specific window of time.
Yes, it is hyper-concentrated in a very specific window,
Yeah.
generally the first 5 to 10 years of retirement.
Ah.
This is the window where the transition happens, where withdrawals begin, and your portfolio has the least amount of time to recover from an early setback.
Right, because if you take a massive hit at age 65, the compounding engine breaks right when you need it most.
Exactly. But if you take that same hit at age 85, your portfolio has already done decades of heavy lifting, and the impact is relatively negligible.
So who needs to be paying the closest attention to this right now? Like, if I'm listening to this, how do I know if I'm standing in the danger window?
Right. If you are between the ages of 55 and 70, you have somewhere between $500,000 and $5 million in assets, and you are within 10 years of your target retirement date, you are in the exact window where this risk is the most dangerous.
But logically, that is also the window where it is the most fixable.
Yes, because you still have time to build the architecture before the withdrawals actually start. You can redirect funds, you can set up the shields, and lock in the floor.
Right.
However, that window doesn't stay open forever.
Right, the IRS gets involved.
The government eventually forces your hand. Once the required minimum distribution, or RMD, window kicks in at age 73, the IRS forces you to start taking money out of your tax-deferred accounts whether you want to or not.
Wow.
And once that forced distribution begins, your options to restructure and protect those assets narrow significantly.
Which brings us to the concept of stress testing. Because I guarantee a lot of people are listening to this, thinking about their 401k and telling themselves, well, I talked to my advisor last year and they ran the numbers and they said I'm fine.
Yeah, we hear that all the time.
But as we established earlier with the Monte Carlo simulations, fine is often just a probability score. What they actually need is a sequence stress test.
Exactly. A standard projection shows you what happens if everything goes according to average. A sequence stress test deliberately tries to break your plan to find the hidden cracks.
Okay, how does it do that?
It doesn't just look at whether your overall balance survives a theoretical 30-year timeline. It specifically targets that danger window.
The first 5 to 10 years.
Right. It models a severe market drop, like a 30% decline, landing specifically in year 1 or year 2 of your retirement. And it tracks what happens to your actual monthly income when you are forced to navigate that drop.
I see, so it tests the integrity of the floor, not just how high the ceiling goes.
Exactly. If that stress test shows that a year 1 crash forces you to reduce your standard of living or forces you to liquidate your growth assets at a steep loss just to survive, then you have a structural gap in your plan. You have a withdrawal strategy based on hope, not an income architecture based on guarantees.
Wow. So what does this all mean for you, the listener, as you look at your own accounts? I mean, we've covered a tremendous amount of ground, from deceptive averages and the mechanics of forced selling to the power of a closed floor using fixed index annuities.
Yeah, and I want to leave you with a final shift in perspective, drawing directly from the core philosophy of the income standard.
Okay.
A lot of people worry deeply about outliving their money. For a married couple, both aged 65 today, there is a 50% chance that at least one of them will live to age 95.
Which is amazing, but also financially daunting.
Right. And most of the financial industry views that longevity as a probability problem, like, will the money last long enough?
Yeah.
But as the devastating math of investor A and investor B clearly shows us, longevity is not a probability problem. It is actually a design problem.
I really love that framing.
Yeah, if you fix the sequence risk at the start of the descent, if you purposefully build the architecture to shield those highly vulnerable early years, the length of the journey just takes care of itself. The portfolio is protected from forced liquidation, the basic income floor is contractually guaranteed, and the risk of outliving your money is fundamentally neutralized by the very structure of the plan.
It's about engineering the outcome, so you don't have to guess.
Exactly.
Well, if you want to dig deeper into the full framework we discussed today, everything we covered is laid out in Tod Long's book, The Income Standard. How to Engineer Retirement Income You Can't Outlive.
Highly recommend it.
Yeah, you can find it in paperback, hardcover, or Kindle over at theincomestandard.com/book, or just search for it on Amazon.
And if you want to hear these concepts unpacked directly from the source, we really recommend checking out the flagship Income Standard podcast.
Yeah.
You can hear Tod Long exploring these strategies in his own voice, with full episodes dedicated to closing the structural gaps in your retirement plan.
And hey, if you are curious where you currently stand, there's a free income gap calculator available on the resources page of Todd's site. It's a fantastic starting point to see if your floor is actually closed.
Right. But if you are in that 5 to 10 year pre-retirement window we talked about, or even if you are already in the first few years of your retirement and you realize your plan has never actually been stress tested for a year one market crash, you should definitely look into the Income Standard Review.
Right. They offer a free no-pitch review that includes the exact sequence stress test we outlined today. It takes about 45 to 60 minutes, and by the end of that conversation, you'll know exactly whether your income architecture can withstand stepping off the mountain into a storm.
It truly is the difference between hoping you are fine and knowing you are protected.
Thank you so much for joining us on this companion deep dive. It is always a privilege to unpack these critical strategies.
We really appreciate you tuning in.
We invite you back for our next discussion on the safe descent, where we will continue exploring how to engineer a retirement you can't outlive. But until next time, I want to leave you with one final thought to mull over. We have spent this entire discussion focusing on the sequence of your financial returns. You know, how a bad market at the start of retirement can ruin your portfolio. But think about how sequence risk applies to the rest of your life.
Oh, that's interesting.
What about the sequence of your health or your physical vitality? The first 5 to 10 years of your retirement are also likely to be your most active, healthy years. If your financial plan is so fragile that a market drop forces you to pinch pennies, cancel trips, and stress out during your most capable years, you aren't just losing money.
Right.
You are losing the irreplaceable sequence of your best remaining time. So build the floor, protect the early years, and go enjoy the descent.